So in this market full of greed, how can you as a beginner investor or trader identify if the stock is just an irrational pump and dump stock or an actually good fundamental investment that you might want to hold for a long period of time? I really hope that this video breaks it down easy enough that if you're just getting started, you can use the examples that we talk about today to hopefully make a more informed trade or investment decision. With that being said, if you have any questions, feel free to comment down below after watching the video. And don't forget to drop a thumbs up and subscribe if you feel like we earned it. That being said, let's jump right into it. I want to use Amazon as an example. I want to use it as a benchmark. This is a company with a stock price that has been incredibly bullish over a long period of time. But Amazon's PE ratio has been not increasing with the stock price. So what that means is the PE ratio is viewed as the price of the current company or stock that you're thinking about investing in versus its earnings. Because remember, these are not just names, these are businesses that you are hopefully investing in because you see the potential for it to actually grow. A business is there to make money, plain and simple. So yes, although not every company, especially when they're just getting started, is going to look like Amazon, no question about it. But if we use it as a benchmark and based off of your understanding of the differences or the discrepancies between Amazon and its performance and whatever company it is that you are considering, you can then make a more informed decision that, hey, if we can see that there is a disconnect between that investment and Amazon, then at that point, you should be more informed of the greater form of risk that it might come at. You shouldn't be surprised by that, but you should understand that the more that it strays away from this benchmark, most likely the riskier that investment is. There's nothing wrong with risky investments if you can tolerate it and if you're informed of it. But that's the biggest thing. I believe that right now, during an incredibly bullish market where valuations are at levels we haven't seen before, that people are trying to justify or not even taking into consideration the current valuation, but just chasing the popular names because they think that this rally will last forever. You want to remind yourself that markets are full of cycles. There are bull cycles and there are bear cycles. I would remind you to look back to QQQ and pull it up on the day chart. If you want to see what a bear cycle might look like, look at 2022 to 2023. This bear cycle was about 12 months long. And if you started investing in 2022, you would have maybe thought that investing in the stock market was rigged. Maybe it was the worst decision you ever made. It's not so much about the decision, it's more about the timing. So this is where, again, it's very important for you to understand that if you're doing very well right now, you need to remind yourself, you're taking advantage of a market during a bull cycle. I'm not saying that it's easy, it's simply easier because direction and market sentiment has been in your favor. Now, again, it comes with seasoned investors that they're the ones that at these overbought levels and understanding that these cycles don't last forever, they're mindful of their position size, they're mindful of their leverage, and they always have cash on the sidelines that if, again, markets do begin to change sentiment and begin to downturn, they're able to take advantage of those dip buy opportunities because they didn't get too greedy or too leveraged at overbought levels. So the example that I want to give is something like Amazon. Amazon has had an amazing performance when it comes down to its price. And what I mean by that is if we pull up Amazon here on the Moomoo trading application, we can quickly see that, hey, this is a stock that has been consistently making higher highs and higher lows. It's been incredibly bullish over a long period of time. It's not just for no reason, right? This is a successful business. When you look at the PE ratio, the premium that you are paying to own the stock, the premium has been going down. So what does that tell us? That means that although Amazon has been generating more revenue and its price has been going up, it's been still generating more revenue than the actual increase that we've seen in the price. And that is why we are seeing the PE ratio actually decline. Remember, The lower the PE ratio is, the less of a premium you are paying. This is the concern. If you now take into consideration companies with incredibly high PE ratios, again, I'm just using this as an example, do not get offended, PLTR. PLTR has a PE ratio of over 500. Let me pull it up very quickly. PLTR, once we pull it up, has a PE ratio of 551 times its earnings, meaning that you are paying an insane premium, but it's a very popular stock, but you are paying an insane premium to own the stock because although it's a popular stock and its price is incredibly bullish, I mean, it speaks for itself. It's one of the top 15 best performing stocks of 2025. So again, the price is so attractive, but on the business side of things, fundamentally, it's not there. It doesn't earn what it's currently valued at. And that's the disconnect. So as long as you are aware that there's a disconnect there, you can make a more informed decision, right? You shouldn't be scared to invest in these, hyper bullish stocks if you know how to manage risk and you know how to manage your position size and you're aware of it. My concern is beginners aren't aware of it. They're not taking it into consideration and they don't know that PLTR is trading at an insane premium. It's not about the what if, it's about the what will happen. Again, it's always during these bull cycles that the market supports irrational valuations, the 500x PE ratio. But as soon as we begin to see a downturn, just like we saw during the trade war, right? This retracement that we saw from highs of 124 all the way to lows of $66, it lost 50% of its value. Half of its value is gone. Remember, it only has 100% to lose. It lost half of that in 45 days. It's always the most irrational stocks that experienced the largest downturn. But then again, things were covered. It pushed up to new highs. But now, again, we're at these higher levels. I also want to use one of my favorites right now, Open. Open is one of the best performing stocks, I think the top 5 best performing stocks of 2025. And this is just because of the past 3 months, 3 to 4 months. It was trading at 50 cents per share. Now it's trading at $8 to $9 per share, but at one point it was nearly at $11. That's over 1,000% ROI in just 3 months. There's a handful of things I can say about Open. But when you look at its PE ratio, let me pull this up very quickly. Open is a company that loses $305 million a year. Open is not a new company. It's been an existing company that's been here for quite some time. It has a negative PE ratio because it loses so much money. Negative 21.3 times its earnings. And this negative PE ratio hasn't been getting better, as you can see from this chart. It's been getting worse. So again, everything, right? Analyst targets, if you look at the actual business under the pro research for investing.com, you can see that its revenue has been declining based off of recent quarters. This isn't an opinion, it's a fact. Open is a dying company. Its revenue is declining. It's not skyrocketing to justify in any way a 1,000% ROI. But then again, there's a difference between a trade and an investment. It makes sense on why people that picked up on this early on took advantage of it. They're trading Open because it's so bullish and they're making so much money off of it. There's nothing wrong with that as long as you understand that this is short-lived, just like GameStop and AMC. These are the new meme stocks. Let me make this very clear. Supposedly Open has brought in back their old CEO and some original executives and they're implementing AI. Who cares? Why did they choose Open versus Zillow? They're essentially the same type of business, but Open was trading at 51 cents per share. It had almost no trading volume just 4 months ago. So it was an easy stock to manipulate. Those that probably created all of this got in early, 50 cents per share, and drove this up the wazoo, right? Now trading at highs of $8.80 per share. This was a company that was trading at $1 billion market cap, now has a market cap of $6.4 billion. It's not fundamentally a growing company. Its revenue is declining. Everything All the red flags are there. And this is only sustainable during irrational, bullish markets. As soon as reality sinks in, we all know when you look at the data, Open is a dying company. There's a reason it was trading at 50 cents per share, because it was worthless and it was selling off because it wasn't or was no longer a growing company. So again, by paying attention and being aware of a benchmark, of seeing, okay, this is a company with healthy price action, the price going up, but also a declining PE ratio because the business is actually growing, versus Open. What do you hear about Open? You hear that, again, just a bunch of people trying to convince you to buy it because they need the pump to continue for them to make money. No one is convincing you that you need to buy Amazon or Nvidia or Apple, because you don't need to be convinced. The business side itself, if you know how to do a fundamental analysis, speaks for itself. They print money. Open, just like all these other gimmicky companies like MSTR, need to convince you that they are the future. They need to convince you that they are getting better, but their fundamentals don't align with their talk, right? It's easy to say things, but just like we've seen in the past before, from Nikola to now Oklo, all these companies talk big game, but never walk the walk. Just like Nikola at one point hit a $30 billion market cap within a very short period of time. Then they were investigated, found for fraud, and now they've been delisted from the stock market. Just like Oklo. Oklo is a pre-revenue based company that, again, recently pumped up, but yet if you look at anything about this company, it would never justify this move. And that is why there are so many people on the inside of executives dumping shares. This is what Oklo markets themselves as, a super futuristic, aesthetic, and high-tech company, versus their actual HQ, a little suite across the street from a local Whole Foods. Again, do not fall for the hype in a market full of greed. By understanding what a good company is supposed to look like, most of these will never look like this because Amazon is a unicorn. Like, let's call it for what it is. But if we have a benchmark like Amazon of a declining PE ratio and an ascending stock price, the more that we stray away from that benchmark, the riskier that we should understand that that investment becomes. So at least you're no longer going to be surprised that by understanding the PE ratio and the correlation to the stock price, that as long as you are aware of it, you should be informed enough to not be surprised if it completely turns against you. It should hopefully encourage you to not be afraid to take advantage of risky investments because, again, everyone has their own form of risk tolerance, but to not be surprised. And that's the whole point of all of this, is that you should be taking additional steps in a market full of greed to make sure that you're well informed, to not just buy any stock because it's being promoted on Twitter and to believe what it is that they're saying, but to actually understand the business itself and to differentiate. Hey, is this just a pump and dump that could possibly make a good trade because momentum is in its favor? Or is this actually a fundamentally good business that I possibly actually want to invest in and be a part of? And then again, by using this benchmark, you can see, well, how risky do I stray away from a benchmark like Amazon? Because that's the goal, right? To invest early into businesses that might not be like Amazon, but hopefully work towards being more like in the future. But there has to be some form of connection there, right? Increasing revenue and increasing profits with the increasing price, not just increasing price and declining revenue and inclining PE ratio, or I guess in Open or Oklo's example, negative PE ratio. That is the great reminder, is again, in a market full of greed, just be a little bit more calculated and hopefully you will be a little bit more intentional. You should never be afraid to take advantage of risky investments or trades as long as you do it in an informed and calculated way. And again, one of the things that we were having a conversation with this week is that there really isn't many good deals, right? Markets are sitting nearly at all-time highs. Valuations are incredibly irrational. It's like, well, what stock can I invest in right now that is considered safe? Well, there aren't many, right? Because if overall markets begin to downturn, even the Magnificent Seven stocks will begin to retrace. One thing that I do want to let you guys know is that if you haven't considered it already, Moomoo is actually offering the ability to earn up to 8.1% APY, meaning that you'll just actually earn up to 8.1% interest on your uninvested cash as it just sits in your account. Think about that. 8.1%. That is possibly a lot more than, let's say, maybe the NASDAQ can make in the next 6 to 12 months based off of if markets begin to retrace, at least you're still making interest off of your money that you don't have invested, literally for just sitting there. And that's a promotion that Moomoo currently has going on. So if you're tired of your old and outdated brokerage, not only can you earn up to 8.1% APY, but you can also earn and unlock up to $1,000 of NVIDIA stock, depending on your qualified deposit. This promotion is expected to end September 30th. So if you want to check it out, just take 1 minute, click that first link in the description down below and see if Moomoo is a good fit for you. Other than that, I really do appreciate you guys' time. You guys let me know down in the comment section what you think. Again, our goals here are not to discourage you from investing or trading in risky stocks because we know that that's attractive to a lot of people, but to simply inform you on how you can inform yourself more on the risk that those opportunities might yield. Not to be afraid, but to not be surprised if it turns against you, right? So you can be a little bit more intentional with your position size that you decide to take instead of going in with maybe 100% of your position size. You respect the risk and maybe go in with 20 to 30% because you understand that it's a riskier trade. And with riskier trades, doesn't mean that needs to scare you. It just means that maybe you just give it less exposure to feel more comfortable tolerating that volatility. That's one conversation that we have with our LPP team all the time. So again, I'd love to invite you to our live trading session whenever you feel like you are ready to watch me trade live. I do it every single morning right at market open, and it's the second link in the description down below. If you have any questions after this video, feel free to comment down below. And again, everything is linked in the description, so feel free to check it out. Like always, let's make sure that we end the year on a green note. Take care, team.